Are we able to take more deductions, or is that something that we can utilize in our business? Today, we're going to be talking about midterm rental strategies. And I find that to be sometimes confusing to a lot of people. And a lot of people that are rich or financially savvy have these understandings and they have the right people in the right spots. It's so hard to find the right CPAs that understand real estate, and you got to make sure it works. I mean, at the end of the day, and it's totally different than the short-term rental industry, but I do feel there's a lot more advantages to it. I'm super excited today because we have Amanda and Matt with us who are tax experts. In fact, I had the luxury of having you two both at the Midterm Rental Summit in San Diego this year, and I'm super, super grateful. And one of the cool things about you two is that, first off, you're a couple in this space. I think that's cool because a lot of times in this space, like, it's hard to work with a significant other. That's just maybe my opinion. And maybe we could talk about that for a second. If you guys want to introduce yourselves, let's talk about who you guys are real quick.
Well, yeah, thanks for having us, Jesse. It was definitely fun to speak at your summit, and enjoy being back again. I'm Matt MacFarland. This is my wife, Amanda Han. We are real estate investors and business owners. We're CPAs and strategists. Our firm, KeyStone CPA, focuses on specializing in working with real estate investors all over the country on various strategies to kind of, obviously keep more of your hard-earned money and reinvest it and build your wealth.
Yeah, and we're excited to be here to talk about midterm rental tax strategies. When it comes to clients, we have a lot of clients who invest in all types of real estate. So a lot of long-term, traditional long-term investors. Had a lot of people go into the short-term rental space, and now, of course, midterm rental is almost like the next best thing. And there's, I think, a lot of unknowns and confusions with respect to how does it benefit real estate investors in this space. So really excited to kind of dive into all that stuff.
Yeah, and the geeky tax stuff is what most people aren't aware of. In fact, there's a lot of tax savings that people can, generate, and it's just by understanding all and being, in contact with the right CPAs. And I think that's where I've been through probably 3 CPAs in the last probably 3 years, because just simple things that are over missed, that are not, looked at. So I'm excited today to talk about that. So let's talk about the differences, because I know that there's a short-term rental loophole. So a lot of folks that have short-term rentals can deduct quite a bit. Can you talk about that? And then we can dive into the similarities between the two. And Amanda, you and I really dove into this at the summit, and we can go into this a little bit further, but let's just talk about the tax implications or the tax benefits that we have with short-term and how maybe some of those can translate to the midterm space.
I think I want to first start off by addressing something really important for everyone to understand, and that is the fact that regardless of what type of real estate you're investing in, whether it's long-term rentals, midterm, or short-term, we can all take advantage of tax deductions and write-offs. And this is true regardless of whether you maybe have a legal entity or not, right? So we're going to dive a little bit into the differences between the properties, the types of properties in terms of how any tax losses are utilized, but just in general, as a midterm rental investor, you are able to take advantage of all the tax benefits as most investors do. In other words, we can write off when we use our car for our midterm rental. We can write off a home office that we're working from. We can write off the tickets that we pay to go to a real estate conference, right? So those facts are true regardless of what type of real estate you're investing in, and that holds true for midterm rentals as well.
Yeah, I think it's good to point out to everyone who's not aware of the different, basically the distinction in the tax world of what is a short-term rental. Generally speaking, a short-term rental is a property where the average customer use is 7 days or less for the year. So 7 days or less, you've got a short-term rental. 8 or more, you've got, midterm rental, long-term rental, whatever you want to call it, right? So that's kind of an important distinction. So yeah, if you, look back in the year and your property has average customer stay of 6.3 days, and you've got a short-term rental. It doesn't matter necessarily what platform you put it on or anything like that. Now, from a tax perspective, the short-term rental, loophole or strategy you were kind of referring to, Jesse, is, if you're able to create a loss for tax purposes on your rental property. And when we say loss, we're not meaning that you're losing money. It's just, maybe you've maximized depreciation, maybe you've maximized paying your kids, maybe you've maximized some of these other deductions, right? On paper, we're creating a loss. The question would be, how do we, can we use that loss to deduct it against other income, W-2, business income, the other, pass-through income, whatever it might be.
And if you're someone who invests in traditional long-term rentals and you have higher income, typically that's 150,000 or more just in your other income. If you invest in long-term rentals, you a lot of times you're not able to use that loss against your W-2 income unless you're a real estate professional. And there's a couple of rules you have to meet to be a real estate professional, but one of the hardest ones to meet is that you have to spend more time in real estate than your job. And so for a lot of our clients who have a full-time job or both spouses are still working full-time, investing in long-term rentals, what happens is, you have all these write-offs that you can offset your taxes from the rental income, but you're not really utilizing it to offset taxes from the W-2 income. And so because of that limitation, long-term rental, for certain long-term rental investors, the tax savings is a little bit deferred, right? We don't get the benefit right now. We're kind of going to get it down the road. And that's where kind of the short-term rental loophole comes in, because for people who are investing in short-term rentals, you don't necessarily have to be a real estate professional, meaning you don't have to spend more time in real estate than your job. And there are ways for you to use some of those short-term rental losses that are, again, strategically created to then offset taxes from W-2 income.
Got you. Okay. So what are some of those, you're talking about specific things, like what are some of those loopholes that you're referring to right here? Is it depreciation, or what exactly is that?
Yeah, that's interesting. So when we talk about using strategies to create tax losses, right? Like Matt said, we're not going to lose money, we're making money. But what are some of the things that we can strategically do to create a loss? So one thing I kind of mentioned earlier was, okay, let's take a look at what are some of our expenses that are traditionally personal that we can't write off. But if we now have a business component, can we then shift that into a business expense? So things like the business use of your car, your home office. If you have kids, I know, your son is at a good age probably. So you have kids who can help out in your rental properties. How do we pay them and sort of be able to take a tax deduction on that kind of money? And of course, depreciation, accelerate depreciation. So there's a whole toolkit of strategies that we can all use to create low to no income tax on the real estate. And like Vasquez, for the most part, if we're good at that part of it, what happens is then we create a loss, right? So what happens to that loss? How can we use it? And that's where the distinction of mid-term rental, long-term rental, short-term rental comes in.
Got it. So here's where I got in a situation before with losses, where I had so many losses, and I think a lot of people have this. If you run your own business and you show a lot of losses, when you go to buy property, sometimes the banks will look at that and be like, well, you guys didn't actually make any money last year, right? Because the deductions they look like you're losing money rather than earning money. So how, for me, when I left my W-2 job, that's where I put myself in a really bad spot, because I was operating my business for a couple of years, but we were taking a lot of deductions. So what would you suggest for people that are doing that to, that have a secondary job or this, a side business or side hustle, on how they can leverage that? Because again, like the goal for most Americans is like, how do we pay less taxes? We look at like Donald Trump and all these other people that are paying like literally zero taxes, right? We're just like, and I hear a lot of people are just like, that's not fair. But most people, this is an advantage that we have, and I heard Donald Trump say this one time, and I don't want to get into politics, but he's like, they just didn't have good accountants, or those people don't have good accountants, or they don't have, people that understand this stuff in the right way. And a lot of people that are rich or financially savvy have these understandings, and they have the right people in the right spot. So can you talk about that real quick on how, how the average person can leverage that, but also how we can keep ourselves in our businesses to show that there's income, or what the losses look like on both ends if we were to buy more property?
It's a great question, because our clients run into this all the time, because it's same point. They're trying to qualify for loans, but at the same time, obviously, they're trying to reduce their taxes and save more money and not, give the government more than they need to, right? And so what we kind of talk to clients about is just making sure that you are working with a mortgage broker or a lender who does work with real estate investors and has experience working with real estate investors, right? Because if you can work with somebody like that, then that conversation is a lot easier to have, where it's like, hey, yeah, my rental property lost $40,000, showed $40,000 loss, but you can see here on line, whatever line it is, that depreciation expense was $50,000 of that. And they're going to, because they work with real estate, but they're going to know that you're not paying $50,000 out of pocket for depreciation. It's you're taking that annual expense every year, or you're using bank. That's based on your purchase price, right? It's not an expense you paid for that year. So I think that's where it's important to kind of work with, lenders, mortgage brokers, like I said, who have experience of working with real estate investors. So they kind of they understand the game, for lack of a better term.
I think also too, besides just understanding that depreciation is a tax benefit that doesn't hurt your borrowing ability, but just also other things like a car expense, for example, right? So when you write off the business use of your car, it typically doesn't hurt your borrowing ability. Why? Because if you have a loan on that car, that's already part of your debt to income ratio. The lender has already looked at it. And also just other like non-recurring expenses, like one-off things, right? So this year I spent $30,000 on improvements for my rental. Well, if you talk to the underwriter, you can let them know, hey, this is not going to recur again, right? It was like one-off, I did an improvement. So just being more strategic about working with the lender in what is actually in the tax return goes a long way. We also tell clients too, if you are concerned about your borrowing ability, then we'll send a draft tax return to the lender before it's actually submitted with the IRS. So that way you can kind of get their blessing to make sure that everyone's on the same page.
Yeah, I love that. Especially, because most people that are entrepreneurs wait till the last minute to September 30th, September 15th. I don't remember I haven't completely finished my taxes for last year. I think most entrepreneurs are there.
I was going to say that. I didn't want to point that out.
You guys probably hate that. You're just like, oh my God, everybody's slamming me with this last minute stuff. And I think most entrepreneurs that I know are like that. It's like, we're waiting to the last minute. But you just mentioned something that's so important, is that if you have a CPA, they can draft stuff for you ahead of time. You give that to the lender, let them look at that, and then you guys can make moves and adjustments based off of that. And I think that's where, it's really important to have a real estate investor, because you guys are investors as well as CPAs in this space. So I think that's so cool, because most CPAs don't invest in real estate, which I don't understand, because they see all these people that are generating income, but then they don't invest themselves. So that's kudos to you guys for being able to do that. So I have a couple questions that people had wrote, and I thank you for that information. I want to read these off. So one of the questions is, we talked about this already. What's the main differences between short-term and mid-term rental tax loopholes? Here's a question that I have that I want to bring up to you guys. So you guys know, and you heard at the summit that I talked about how I operate my business is very different than most people that are operating mid-term rentals. They basically just list on Furnish Finder, list on Airbnb, and wait for people to book. Where I do things completely different. We're actually going after the agencies. We're connecting with these agencies. Not only that, but we have weekly cleaners that come in. We have vehicles that people can rent. We have grocery delivery service where people will actually take food to the technicians or the doctors or people that are staying at the property. So with those types of things that are operating more like a hotel, because essentially that's what we're doing. It's almost like a hotel. Are we able to take more deductions, or is that something that we can utilize in our business as opposed to the traditional people that are just doing things like on Airbnb and VRBO? Can you talk about that a minute?
Yeah, that's a really interesting way to describe it, because you're right. That's kind of what we see too in terms of our clients who have midterm rentals. A lot of people are a little bit more passive, right? It's kind of like maybe people come, they stay here for a month and then they leave. When you operate it in that traditional way, from a tax perspective, the midterm rental is treated just like a long-term rental, okay? Which could be good or bad. The times would be good is if you're an investor who already has a bunch of long-term rentals, now you're getting into short-term rentals, the midterm rental space, and let's say you or your spouse is already a real estate professional, then that's great, because I can already strategically create midterm rental losses and just combine it with all the rest of my long-term rentals and take a benefit and offset W-2 and other income, right? But now for someone else who maybe is still working a full-time W-2 job as a single person, or a married couple both working W-2 job, then it could be a little bit detrimental, because, again, if you're not providing these hotel type services, your midterm rental is treated just like a long-term rental, which simply means that your tax benefits are a little bit deferred. Like, you don't get to use the current year losses against W-2 or other income you might generate. It certainly offsets the rental incomes for tax purposes, so that's still really great, but it's just not like as good. But, in kind of what you described, where you're a midterm rental operator, and like Matt said, midterm rental operator for this context is typically 30 days or less. So you operate your midterm rental business, but you have all these added services like cars and cleaning and laundry service, whatever it is that you offer. Then it starts to operate like a hotel. And for a hotel business, it kind of mimics that short-term rental loophole in that you don't have to have more time in real estate than your job. You could still potentially use the losses against W-2 income as long as you meet material participation out.
And I think that's the tough part is the meeting the hours, because it's so different. And I'll kind of give you guys a breakdown of what this looks like so that you get more context. So what I teach my students and stuff in class is to go after these agencies. We're creating, we're building our home on our own land, which unlike Airbnb and VRBO, like we're waiting for that's Brian Chesky's land. We're like basically employees of Brian Chesky, right? The owner of Airbnb. But for us in this space, we're building our own business, essentially just like you guys. Then these people come to us, but we spend quite a bit of hours, outbound phone calls, emails, connections, putting together sources just like cars that are rented to these, travel nurses, a grocery delivery service for doctors that are working 15, 16 hours a day. They'll come back home, open the fridge, and then there's their favorite, beverage or, their almond milk they wanted, stuff like that. So it's all basically there. And I think that's where, I find, and you just mentioned this right now, that since we're operating that way, we can take advantage of somewhat of those short-term rental and this is me air quoting right now, short-term rental loopholes, because we're essentially operating in that same way. And would those hours of connecting with folks or connecting with agencies, connecting with realtors, would those count as, real estate professional hours?
Yeah, I think that it comes down to, is the property going to be treated more like a long-term rental for taxes, or is it going to be treated more like a short-term rental? And that's where, if it's a long-term rental, then does it count towards the real estate professional hours, like the 750-hour requirement and all that stuff? It definitely should. Now, if it's going to be treated like a short-term rental, can it count towards the material participation hours? I would make the argument that it definitely does, because you're putting all those hours into get that property up and running, get it, ready to go and all that stuff. And that's definitely where I would go down that path for sure.
And I want to just make a really kind of technical distinction, because I know your question was, okay, does the hours I'm doing to build my business count towards real estate professional? When actually the question really should be, do those hours count towards material participation? And the reason that is important is because if you're operating your midterm rental like a hotel business, you don't have to be a real estate professional to use the losses. You just have to meet material participation hours. So in other words, we don't even care if you are a real estate professional, because it has no impact on whether you can use the losses from your hotel business. And so then really the question is, okay, what are material participation hours that I have to meet, right? There's 7 different ways to meet material participation. You only have to meet one of them. But we'll kind of talk about the top 3 that are most commonly seen. So material participation for your hotel business, one would be that you spend at least 500 hours on these midterm rental properties, right? That fall within this hotel category. So if you spend at least 500 hours on it, then you would have met material participation, which means any losses created on these midterm rentals can offset W-2 and other income. Again, doesn't have anything to do with real estate professional. We don't care how many hours you work at your job at all. Okay.
Yeah, and if you can't get to 500, then the next tier down is, did you spend at least 100 hours of these right type of material participation time? And it's more time than any other single person or business spent on your specific, hotel type properties. Meaning, you spend 150 hours, and you look around, and I don't know, the gardening crew spent 140, and that's the highest amount of hours anyone else spent. Then you've surpassed this test, and you've met this material participation requirement.
Yeah.
So that's, first one's 500 hours. Next tier down is this 100 and more time than anyone else. If you can't get to 100, then the third tier is possible tier is add up all the time you spend on your, kind of midterm hotel type properties. Is it more time than everybody else who spent time on your property, these specific properties? So again, I don't know, you spend 90 and you add up everyone else's time to 85, then you've met this test. So, there's a few different ways you can do it, obviously. And it's just, it's a matter of kind of making sure, figuring out where the property falls in terms of, again, is it a short-term rental? Is it a short-term rental with hotel services? Is it a long, that kind of distinction, right?
Yeah, perfect. Well, because I have so many people that I talk to that are just like, I'm trying to become a real estate professional. I have to document everything. I need to make sure I have enough time in this. And it's like they're working W-2 jobs, 9 to 5, and then they're trying to get this other, you need to have 750 hours in order to be deemed as a medical or a real estate professional. And I find that to be sometimes confusing to a lot of people because they're not necessarily understanding that. But you're saying in this space that we don't necessarily need to have that real estate professional, but as long as we have material time that is spent on this actual business, which again, like we talked about, calling these agencies, connecting with recruiters, talking to relocation specialists, talking to real estate agents, going over the properties, like there's so many hours that are spent doing that. It is not passive at all in any single way at all. So, I mean, I feel like just that alone, if people were to, if I was to document my team on that, which we do, we spend so many hours doing that on a regular basis. And even a one-off person that's getting into the midterm rental space, they're going to spend quite a bit of time to do that. So what would you say would be the best way to start, tracking time? Is it just like writing it in a notepad? Is it documented on QuickBooks? Like, what would you guys suggest to folks?
It's a good question. I think, and then, I think it brings up the point too. It's definitely important for everybody to kind of work with their own team of advisors on their specific situation, because everybody's situation is going to be slightly different, but in terms of documenting hours, we tell clients to kind of find the method that works for you. So what I mean by that is, like, some clients are really good with using Excel. And if you're good with using Excel and you're going to keep up with it, then yeah, you can keep your time logged on Excel, dates, number of hours, description as detailed as possible, what you did. Some people are, very tech savvy, like to use apps. That's great. If you, use an app, believe it or not, there's probably still some people out there that like to write things down on paper.
That's me.
And if you are somebody that, we can do that, then God bless you. But the point being is that, find a method that you're going to stick with, and don't start one and then switch to a second one and switch to a third method in month 4, because if you did get audited for some reason, the IRS is going to get a lot more weight to somebody that's more organized and kind of consistent in how they do things.
And I just wanted to add something. When it comes to material participation hours, an important distinction to understand is that those are your hours. So it would not include the hours of other people you hire, right? So for example, if I'm the one, building the relationship, contacting the insurance companies, that's great. That would be hours that I've incurred. But if I've actually hired someone to do that for me, those would be the other people's hours. And remember how we talked about a couple different ways to meet the hours, 2 of which are like my hours versus other people. So something important to understand. Then when we talk about documentation, those are like your hours, not the hours of like someone you've hired.
Got you. Okay, perfect. Yeah, no, that makes complete sense. And I'm glad you brought that up. And just for the record, I take photos of every single all my my hours, and I send it to my virtual assistant, and then she documents in Excel because I suck at Excel. Like, I am not good at Excel at all. So she's the Excel queen and handles all that stuff. But yeah, I mean, that was one of the things when I first started. And you guys probably had this, people would just show up with shoe boxes full of like receipts, and like, that was me like in the early 2015, 2016. I literally go to my tax person and drop off a Vans shoebox full of.
Yeah, we lock the door if somebody like that's coming. Like, no shoebox wanted.
One time we had someone drop off or show up with a suitcase. And the receptionist called and said, I don't know what to do with this. There's a suitcase.
Was it a big suitcase?
No, it was one of those carry-on size.
Yeah, it was 1975 carry-ons.
That is so funny. What were you saying?
We had somebody show up once that was, they like to, they show up to the office and they bring their papers with them. And they were sitting there. Our receptionist at the time was so nice that she didn't want to kind of stop and correct them. But this person was going through like, okay, well, this form, telling our reception, this is my interest income form, and then going down the line of every single form. And I'm laughing in the other room because I'm like, the receptionist is not preparing your return. She doesn't care what this form is.
Oh, that is funny. Yeah, you know what? I learned that because my parents used to. I mean, I guess back in the 80s and 90s, I just dated myself right now. Watching my parents go do that, they would literally take shoeboxes, all paper. They'd keep everything. They'd have little checkbook receipts. You guys know that from. I don't know if you guys were handling stuff back then, but my parents. So I just learned. I was like, I guess I'm supposed to put receipts inside of a shoebox and then take it over to. I thought that was normal, but I remember at the time, the woman that I was working with looked at me and she's just like, she shook her head a little bit and was like, what am I what am I getting, what am I getting myself into?
That's exactly what she did.
I've since adulted. I now no longer use shoe boxes, so that's fantastic, right?
The one thing I do want to kind of just say again is that midterm rental, the benefit of a midterm rental investor is it's possible that your property be treated as either a long-term rental, right? Mm-hmm. Or it could be treated as a hotel business, kind of like what you were doing, Jesse. So, and for any investor, long-term rental treatment might be better, or the hotel business treatment might be better. It just kind of depends on whether that person has a full-time job or what they're actually doing with respect to the midterm property. So what I love about that is just there's so much planning that could happen, right? And you are the owner of the property. You are fully in control of what you do with respect to the property, how you rent it out, and we have seen clients where the property is partially short-term, partially midterm. And so you can get, with the right planning, you can kind of create the fact pattern that's needed to reduce your taxes. But it's really important because midterm rental space is so new. And I always hear people ask the wrong questions or have the wrong treatment. Like you were saying, right? A midterm rental as a hotel, but they're so worried about real estate professional status, or they're thinking it's a short-term rental, but it's actually not. So little, things that are seemingly small for the average investor can make a huge difference when it comes to taxes.
Yeah, I love you, and thanks for clarifying that. I really think that that's a really great way to bring that up, and a great way to talk about that. But I'm going to segue into this real quick. So for a midterm rental operator that is operating as an arbitrage, is there any deductions that they're able to take on that end? Because there's a lot of folks that are not buying real estate, but they're renting other people's properties and then operating the same way that I just talked about. They're connecting with agencies, they're doing all this stuff. So what can you say about that? How is there, we're talking about tax deductions, and this is typically for people that own property, but what about people that are arbitraging and that are building a business that route?
Yeah, for sure. It's all, when it comes to deductions, it's the same exact types of write-offs that you can take if you're doing rental arbitrage versus if you actually own the rental property that we're talking about here. So yeah, the write-offs are all exactly the same. Whether you can, use it to offset W-2 income or not is exactly the same. The only difference when it comes to arbitrage versus actually ownership of the property is depreciation, right? So in a rental arbitrage, I don't own the real estate, so I'm not going to depreciate the building. I can still certainly depreciate other things I'm putting in the building, like if it's a car that is being used or if it's all the furnishing and stuff. Certainly we can depreciate those, but just not the building.
But keep in mind, obviously, when you're doing the arbitrage, obviously you're paying rent to the actual property owner. So people obviously want to make sure they're deducting that against the income they're bringing in. Now that you may with arbitrage, you may end up with good cash flow numbers. Obviously, if you're doing things correctly. And if that's the situation, hey, we don't have to depreciate the big depreciation, or I have to create paper loss. Well, that might be one of the situations where, hey, maybe I do want this business to be treated as passive, because what I'm thinking in my head is, okay, now we've got some passive income. Maybe we've got other rental properties that have losses that we want, to treat as passive. They can offset each other. Or maybe you've got doing some arbitrage, but then you're investing in other people's deals, like syndications are kicking off losses on their Q1s. And if you're treating your arbitrage as a passive activity, those could offset each other. So, it's a different ways to think about it, but it's, kind of trying to use the tax code to your advantage based on your specific situation, for sure.
See how excited Matt is getting just talking about it.
You see that. I love that. Man, you're getting excited. I love when people get excited about stuff. So, okay, cool. So last question that I have, and this is something that's really, really important for me. A lot of people in this space will run their units as both short-term and midterm. You think you talked about that a minute ago, Amanda? Like, I will do 6 months midterm, 6 months short-term. So how are we able to look at our taxes at that point, since we're operating on both ends for the exact same amount of time? So what would that look like?
It's a good question. So if I'm hearing the question correctly, like if it's the same unit, basically at the end of the year, you kind of, you add up the number of days it was rented out divided by the number of customers. That's your average customer use. So that may or may, again, depending on what you're looking for or what you're trying to accomplish. Now, we've also had situations where someone's got a duplex and one unit is a long-term rental or midterm rental and the other unit is a short-term rental. for tax purposes, there's times where you can show those as two separate properties on your tax return, and you utilize different strategies for those. So it kind of depends on the fact pattern a little bit, but yeah, it's a matter of kind of looking at things at the end of the year, I think.
Yeah, if it's the same unit, and partly short term, partly midterm or long term, that's pretty simple, right? Because it comes down to the average guest stay during the year. So we're just saying January through December, how many bookings, how many nights to get to the average, and that will kind of help categorize, is this going to be treated as a long term, short term, or midterm hotel?
Got it. Yeah, no, I love that. I love the concept. I think so a lot of people will think about like, I'm not actually running a hotel, but in fact, you're running something very similar to that. And I think that's when we talk about running it like a hotel, we're doing the same things that a hotel would do so that we're able to, accelerate depreciation and whatnot on that end. And I think that's so important, especially the way that I talk about doing this. So that's an awesome thing to know. Is there any last things you guys can think about that people should know about in the midterm rental space, or how it differentiates between all the other asset classes that folks should probably know?
I feel like we can do like the whole 8-hour class to some midterm rentals, because then we talk about in future years when you have a lot of taxable income, right? Now as a hotel, we have to pay self-employment taxes. So what are some of the strategies to kind of offset that type of potential tax implication in the future? But I think the main thing really important for midterm rental investors to understand is that you need to know which treatment will be best for you, because again, there's a lot of flexibility in whether it's treated as a long-term rental or more of like a hotel business, and understanding which one is best for your unique situation will help you to determine how you operate that business, and maybe also too, like even where you buy the property, right? Am I going to buy a property that, located in this place where it makes more sense? It's higher end guests coming in that will want to be using a Tesla and having that almond milk in the fridge, right? So those are, you kind of almost like back into where I'm going to invest.
Yeah, I think along the same lines though, too, playing the devil's advocate, like make sure that when you're deciding how to invest, and you're finding properties that are going to, perform for you, right? I mean, that's economically, we're looking for that first and foremost, right? And then figure out how do we incorporate the tax strategies around it and take advantage of the best way possible.
Matt, you just asked a question that I literally get asked probably 100 times a day: is where do I invest in midterm rentals? Where do I buy? And I think that's where understanding this market is so important. And I talk about it all the time. But yeah, you're absolutely right. Something's got a cash flow. And again, you're spending a lot of money to pick up these properties in some cases. And you got to make sure it works. I mean, at the end of the day, and there's not any real software that's out there right now that lets us know, like, AirDNA and things like that. We're having to like manually go in and pull numbers and try to understand the markets. So it's totally different than the short-term rental industry. But I do feel there's a lot more advantages to it. But I'm glad here today talking to you two that I have a better understanding of, the short-term space, the midterm space, and not only that, but how we can, utilize midterm rentals almost the same way as the tax deductions that you'd get from a short-term rental, which again, a lot of people love that, especially the high-earning W-2 folks, to offset their income on that end. So where can folks find you? And you know what? After talking to you guys, like I probably should switch over my CPA. I hope he's not listening to this, but I probably should connect with you guys and go a little bit deeper on this, because I think, again, like it's so hard to find the right CPAs that understand real estate. And I think the better that people, especially if they're investors like you guys, so you understand this in a totally different context. And I think most of your clients are probably real estate investors, right? So yeah, I mean, that's where can folks find you guys, Amanda and Matt?
Yeah, I mean, we work with investors all over the U.S. and I would say the vast majority, maybe 99% of our clients are real estate investors, or at least people who are aggressively looking to start their real estate. So our website is KeyStoneCPA.com, and we have some really great resources and tax updates that you can find from there. If you want to just get daily tax tips, the best place to find me is on Instagram as Amanda Han CPA.
And you can find me sometimes in the background of Instagram on her Instagram.
Matt's just like, I'm going to defer that to Amanda. She can handle it. I'm not going to deal with it. Well, hopefully you guys have a team that handles your Instagram, because that can be cumbersome and tiring, and I'm going to admit that myself. Amanda, you're definitely an influencer, whether you like it or not. So it takes time and energy to put those videos together, right?
Yeah. It forces me to be creative.
I know. And I love the stuff that you have on there because it's small, actionable steps that people can take just by listening. You can just jot it down. So if you guys haven't had a chance, make sure to head over to Amanda's Instagram page because she does drop tips on a regular basis that are fantastic. I will also have your information down in the show notes. If you guys want to set up a call with them, you can. And I'm probably going to be switching over to you guys. So Amanda, Matt, I appreciate you guys for chatting with me today. I really appreciate it. I think our folks out here got a lot of value from this. So thank you so much. And I appreciate it. And just for reference, you guys do not bring shoe boxes to your CPA. They don't like it. You hear it from Matt and Amanda.
Thanks, Jesse.
Thank you.
Thank you guys.